So you know that feeling, right? Your business is growing, and you know the one thing holding you back is a piece of equipment. But man, that stuff is expensive. Well, today we are going to demystify the whole process. We're going to break down exactly how you can get the financing you need to make that next big leap.
I mean, it is the classic chicken and egg problem for pretty much every entrepreneur, isn't it? You need that new truck. You need that upgraded machinery to take on the bigger, better-paying jobs, but you need the revenue from those bigger jobs to afford the equipment. It feels like you're stuck in a loop, and that's exactly where financing comes in. Understanding this process, well, that's the key that unlocks the whole thing and lets you finally break that cycle and scale up.
Okay, so how do we get you from point A, needing the gear, to point B, actually having it humming away at your job site? Here's the game plan for today. First, we're going to talk about where to even start, including some government help you might not know exists. Then, we'll tackle the application gauntlet. After that, we're going to peek inside a lender's brain to see how they tick. We'll dive into structuring the deal itself, and finally, we'll look at the payoff, the good stuff.
All right, let's dive right in. First things first. Before you even start Googling private lenders, you got to know about the support systems that are already out there, literally designed to help businesses just like yours get a leg up.
Okay, so a huge one here in Canada is the Canada Small Business Financing Program, the CSBFP. Now, this is tailored for businesses pulling in less than $10 million a year, and you can get loans up to $1 million for the gear you need. But here's the real magic. The government actually shares the risk with the lender. Think of it like a co-signer. This makes banks way more comfortable saying yes to smaller businesses that they might normally see as a bit of a gamble.
But, no system is perfect, and this one has a pretty big catch. The program requires the lender to do an on-site visit within 90 days. Now think about that. What if you're in a remote community? Maybe your equipment only arrives once a year on the sea lift. That 90-day window, it's not going to happen. It's a total logistical nightmare, a catch-22 that ends up locking out the exact businesses the program should be helping the most.
Okay, so you found a lender you like. Now what? Welcome to part 2, running the application gauntlet. Let's talk about exactly what you need to have in your hands to get that big yes.
All right, think of this as your personal approval toolkit. You're going to need the application form, obviously, a formal quote or invoice from the vendor, that's non-negotiable. Lenders need to see your cash flow, so get 3 to 6 months of your business bank statements ready to go. You'll need a government ID for whoever's signing on the dotted line, but listen up, don't sleep on this last one. You need to explain simply and clearly how this shiny new piece of equipment is going to generate revenue. That is the story that sells the loan.
You know all that paperwork? It really just boils down to the lender asking 3 simple things. 1, who are you? 2, how does your business actually make money? And 3, what exactly are we financing here? If your application clearly answers those 3 questions, you are golden. You're already way ahead of the game.
All right, now for the really interesting part. Let's pull back the curtain and peek inside the lender's brain. How do they actually take all this info you gave them and spit out a yes or a no? Because, let me tell you, the way this works has changed a lot.
So a lot of the time, the journey starts with your personal credit score. Yep, for most small businesses, this is kind of the first hurdle. Lenders just see it as a quick and dirty way to gauge risk. A score in the mid-600s might get your foot in the door, but really, you want to be north of 650 to be in a strong position. But here's the key. It's only a starting point. It's not the whole story.
Because the real revolution, the game changer, is happening behind the scenes. See, the old way of sizing you up was pretty basic, just looking at old data. The new way, it's all powered by AI. We're talking about models that can chew through massive amounts of information, find patterns that a human could never spot, and even factor in stuff like current economic trends. It is a completely different and way more sophisticated way of looking at your business.
And get this, the results are absolutely staggering. A traditional model, it might be right about whether a business will default maybe 69% of the time. But this new AI-powered model, it shoots all the way up to 83% accuracy. I mean, that is a massive leap. For lenders, that means fewer bad loans. And for you, the business owner, it should mean a fairer shot. So, what on earth is a random forest model? It sounds complicated, but the idea is actually pretty cool. Imagine you have a huge decision to make. Instead of asking just one expert for their opinion, what if you could ask 1,000 of them, right? And each one has a slightly different take. Well, that's basically what the model does. It builds hundreds of these little decision trees, each looking at your data from a different angle. And then it just takes the most common answer. It's like crowdsourcing a super smart decision about your credit risk.
But, and this is a big but, all this power comes with a huge challenge. People call it the black box problem. The AI can be crazy accurate, but it's so complex that sometimes even the lender can't tell you exactly why you got rejected. And for you, as a business owner, that is a massive problem. How are you supposed to know what to fix for next time? It's just a no with no explanation. And that raises some really tough questions about fairness and transparency.
Okay, but let's say you got the yes. You're approved. That is awesome. Congratulations. But don't pop the champagne just yet. Now we hit Section 4, structuring the deal. This is where you got to zoom in on the fine print to make sure you're getting a deal that actually works for you.
You're probably going to see one of two main options, an operating lease or a capital lease. The easiest way to think about it is this. An operating lease is basically like renting. The lender owns it, it stays off your books. Simple. A capital lease, on the other hand, is a lot more like buying it with a loan. You take on the risks and rewards of ownership, and the asset gets recorded on your balance sheet. It's a huge distinction for your accountant, and it usually gets triggered when the lease term covers most of the equipment's useful life.
Okay, I need you to remember these 4 letters, PMSI, Purchase Money Security Interest. This is, and I'm not kidding, the lender's secret weapon. It is a special legal claim that basically gives them first dibs on the specific piece of equipment they financed for you. It means if things go sideways, they get to jump to the very front of the line to get their money back ahead of pretty much everyone else.
And listen, if you do business in both Canada and the US, here's a tiny little detail with massive consequences. For that PMSI to be legally airtight, they call it perfecting it, there's a ticking clock. In Canada, the lender has just 15 days after you get the gear. In the US, they get 20 days. It seems like a small difference, right? But for the lender, missing that deadline is a huge and very expensive mistake.
And at last, we've made it to the best part, the payoff. This is what it's all about. Section 5, the payoff and the future. After all that paperwork and nail-biting, what are the real-world benefits for your business's bottom line?
Well, one of the absolute biggest payoffs happens at tax time. See, governments really want businesses like yours to invest and grow. So they create some incredibly powerful incentives. And the savings? They can be a total game changer.
Just to put a number on it, let's look at an example from the US using a couple of popular tax breaks. If a business buys $1.5 million in equipment, their first-year tax savings could be $315,000. Think about that. That is a huge chunk of cash that goes right back into your pocket, ready to fuel that next big project.
But, and you knew there was a catch, right? These amazing benefits don't last forever. Take that big bonus depreciation incentive in the US. It's on a countdown. It was a full 100% back in 2022, but it drops every single year until, poof, it's gone in 2027. So for any business out there thinking about a big purchase, the clock is seriously ticking.
And that brings us right back around to the big final question. We've seen how incredible AI is making lending. It's getting so much smarter. But we also saw how simple, rigid rules can shut the door on good, deserving businesses in places like remote communities. So, as the tech races forward at light speed, the question is, how do we make sure our human systems, the systems of fairness and access, can keep up? How do we build a future where these powerful new tools don't just make the process more efficient, but actually make it fairer for everyone, no matter where they are? That's the real challenge ahead.